The silver market just experienced a 26% obliteration, from 159 down to $85 in a matter of days. Trillions wiped out, retail investors massacred, leveraged traders liquidated, and the entire financial world is asking one question: what the hell just happened? But here's what nobody is telling you. This wasn't random. This wasn't a technical breakdown. This wasn't even about fundamentals. This was a coordinated takedown executed by Chinese speculators who knew exactly what they were doing. And the evidence is hiding in plain sight. Even more critical, if you're thinking about buying this dip right now, you need to hear this first. Because what's coming next week could either validate your conviction or destroy your portfolio. And the signals suggest we're not done yet. If you want the unfiltered truth that mainstream media won't touch, smash that like button, share this with someone who needs to see it, and buckle up. Because what I'm about to show you will completely reframe how you see this crash. I'm Asian Guy, and this is the expose they don't want you to hear. Let's start with what happened. Silver crashed 26% from recent highs of 115 down to 85. That's not a correction. That's not profit taking. That's a systematic destruction of value. Gold fell over 13%. Platinum demolished 27%. Palladium crushed 21%. Across the precious metal sector, over $7 trillion in market cap evaporated. The speed was unprecedented. The violence was extreme. Circuit breakers didn't help. Support levels meant nothing. Technical analysis failed completely. Traders who bought the $110 support got annihilated. Those who held it $100 got liquidated. Those who thought $95 was the bottom watched it slice through like butter. But here's what doesn't make sense. While COMEX was burning, while Western traders were puking positions, while the financial media was declaring the bull market dead, something completely different was happening 7,000 miles away in Shanghai. Shanghai spot silver held at $122. COMEX was at $85. That's a $37 premium, a 43.5% markup. And this isn't new. This premium has been there for weeks. It's been widening, and Chinese buyers have been paying it consistently without hesitation. Now ask yourself, why would Chinese buyers pay 43% more than Americans for the exact same commodity? Why would that premium hold during a 26% crash when historically premiums compress during liquidations? And why would delivery demand in China remain elevated while the paper price in New York collapsed? The answer is simple. Because the Chinese knew something the West didn't. They were the ones driving this entire move, and what happened wasn't a crash, it was a wealth transfer. Here's where it gets interesting. On the exact day that silver started its parabolic move upward weeks ago, the Shanghai Gold Exchange did something unusual. They hiked silver margins to 60%, not 10%, not 20%, 60%. For those who don't trade, let me explain what that means. A 60% margin requirement means you need to put up 60 cents for every dollar of exposure. That's draconian. That effectively kills leverage. Commodity margins typically run 5% to 15%. Going to 60% is a nuclear option that exchanges use when they are terrified of a delivery crisis or runaway speculation. The official explanation: managing volatility and ensuring orderly markets. But here's what actually happened. The Shanghai Gold Exchange saw Chinese speculators piling into silver futures with massive leverage. They saw domestic demand exploding. They saw inventories draining at 5% to 6% per day. And they knew if this continued, they'd face a delivery squeeze that would break the exchange. So they hiked margins to 60% to force speculators to either put up a massive cash or liquidate. And what did those speculators do? They didn't panic. They didn't sell their physical. They sold their futures positions. But not in Shanghai, in New York. Think about it. If you're a Chinese speculator and your domestic exchange just made it prohibitively expensive to hold leveraged positions, where do you go? You go to COMEX, you short the paper market in New York while holding your physical in Shanghai, you crater the Western paper price while maintaining the Eastern physical premium, and you profit from both sides of the trade. Here's what actually happened. And once you see this, the entire crash makes perfect sense. Chinese speculators accumulated massive physical silver positions over the past year. They bought at $25, $30, $35 as the rally built. They watched the Shanghai premium widen from 5% to 10% to 20% to eventually 43%. They knew the physical market was tight. They knew COMEX inventories were draining. They knew industrial demand was surging and mine supply was flat. They knew the setup for a squeeze was building, so they positioned themselves to profit from it. But when the Shanghai Gold Exchange hiked margins to 60%, they faced a choice: liquidate at a loss or get creative. They chose option 3, weaponize the margin hike. They took their leverage that was getting crushed in Shanghai and deployed it in New York. Massive coordinated short selling on COMEX futures, executed in thin trading conditions. Time to trigger algorithmic stops and cascade liquidations. The result? A 26% crash that wipes out Western retail traders, forces Western hedge funds to liquidate, and drops the COMEX paper price to $85. Meanwhile, their physical holdings in China, still worth $122. The premium didn't compress, it widened. Because they weren't selling physical, they were selling paper. This is financial warfare disguised as market dynamics. China has been systematically draining Western silver inventories for months by maintaining elevated premiums. Western refiners ship metal east because they can get 30 plus more per ounce in Shanghai. COMEX registered inventories fall, London vaults drain, Toronto stockpiles shrink, and now, with one coordinated paper short attack, Chinese speculators crater the Western price, shake out Western holders, force liquidations, and set themselves up to buy even more physical at cheaper paper prices, while their existing holdings maintain value in the physical market. Now let's look at the evidence. On first notice, day for February, COMEX silver contracts, 9.4 million ounces of delivery notices were issued. That's 1,881 contracts demanding physical settlement. And this was before the crash accelerated. Wells Fargo issued 701 notices. JP Morgan issued 395 and stopped 487. Macquarie issued 459 and stopped 533. These aren't speculators rolling positions. These are institutions scrambling for physical metal. And if you dig into the details, a significant portion of those deliveries are going to Asian entities. Chinese buyers are using the COMEX system to extract physical metal at paper prices while paying premiums in Shanghai. They're arbitraging the spread. They're draining Western vaults. And they just used a coordinated short attack to make that arbitrage even more profitable. Think about the sequence. Shanghai hikes margins to 60%, forcing Chinese speculators to reduce leverage. Instead of selling physical, they short COMEX paper, crashing the price 26%. Western traders panic and liquidate. COMEX price hits 85. Shanghai price holds at $122. Now, Chinese buyers can demand delivery on COMEX at $85 and immediately sell in Shanghai at $192 for a 37 instant profit. Or better yet, they can accumulate more physical in London or Zurich at depressed paper-linked prices and ship it to Shanghai to meet the domestic demand that's paying a 43% premium. Every ounce they move west to east is a wealth transfer. Every contract they short in New York while holding physical in Shanghai is a profitable hedge. This isn't conspiracy theory. This is arbitrage at a geopolitical scale. And the Shanghai margin hike was the trigger that weaponized it. Now here's where it gets critical. And this is why I'm saying don't buy yet. Because what happens next week will determine whether this crash is over or just beginning. There are three possible scenarios, and only one of them is bullish in the short term. Scenario 1, government shutdown happens. Polymarket is pricing 85% odds that the US government shuts down by January 31st. That's days away. If that happens, the immediate market reaction is risk-off, liquidations, flight to cash, margin calls across all asset classes. Precious metals get sold first because they're seen as liquid and volatile. If we get a shutdown, silver could drop another 10% to 15%. We could test $75 or even $70 as Western traders dump everything to raise cash. Chinese speculators know this. They're positioned for it. They shorted COMEX in anticipation. And they'll cover those shorts at $70, take profits, and then accumulate physical at the lows. Scenario 2. COMEX forces a margin hike of their own. We've already seen COMEX raise margins to $52,000 per contract. But that's not draconian enough to match Shanghai's 60%. If COMEX decides to follow Shanghai's lead and hike margins even higher, it will force another wave of liquidations. Leverage longs will be crushed. The selling pressure could take us to $75 or lower before stabilizing. Chinese speculators are ready for this too. They'll let the paper price crash further, knowing their physical holdings in Shanghai hold value at $122. Every dollar lower in New York is another dollar of arbitrage profit when they buy COMEX delivery and ship east. Scenario 3, the physical market breaks. This is the wild card. If delivery demand at COMEX surges because Chinese buyers see $85 silver as a gift, if registered inventories drop to critical levels, if the exchange can't deliver against contracts, then we get a force majeure situation. COMEX defaults. Paper and physical decouple completely, and silver goes vertical. This scenario is less likely in the next week, but it's the end game. And Chinese speculators are positioning for it by accumulating physical while shorting paper. When the system breaks, they'll be holding the real asset while Western paper holders are left with nothing. If you're thinking about buying this dip, here are the levels that matter. $85 is current support, but it's weak. We've already tested it twice and it's showing cracks. If $85 breaks, the next support is $78 to $80. That's the zone where we had consolidation months ago. If that fails, we're looking at $70 to $75, which aligns with the 200-week moving average. The bear case says we're heading to $70 regardless. The bull case says $85 holds and we rally back above $100 quickly. The realistic case? We'd probably test lower before rebounding. Why? Because the forces driving this crash, Chinese speculators shorting paper, government shutdown risk, potential COMEX margin hikes, haven't resolved yet. The Shanghai premium is your tell. As long as it holds above $30, the physical market is still tight and the crash is paper manipulation. If the premium compresses to $10 or $15, then real physical selling is happening and the fundamentals are breaking. Right now it's $37. That's elevated and holding, which means this is still a paper game. Now let me give you the other side. Because despite everything I just said, the long-term bullish case for silver is stronger than ever. Yes, Chinese speculators orchestrated a short attack. Yes, they're profiting from the crash, but they're not doing it because silver is worthless. They're doing it because silver is scarce and they want more of it at cheaper prices. Think about what the 43% Shanghai premium tells you. It says the physical demand in China is so strong that buyers will pay $120 when New York is offering $85. That's not weakness. That's desperation for physical metal. It says the real price of silver is not $85. It's $122 or higher. The paper price is the lie. The physical price is the truth. 9.4 million ounces of delivery demand before the crash. Banks scrambling for physical, COMEX inventories draining, Shanghai vaults being depleted 5% to 6% per day. These are signs of extreme tightness, not oversupply. The crash didn't change the fundamentals. It exposed the divergence between paper and physical. And here's the kicker. Silver closed January up 19% despite the crash. That's 9 consecutive months of gains. The underlying trend is still bullish. The crash was a violent correction within an ongoing bull market, not the end of the trend. Every major silver crash in the last 20 years set up the next explosive rally. This one is no different. Here's where we are. 3 key takeaways. Number 1, the 26% silver crash was not random. It was coordinated. Chinese speculators facing a 60% margin hike in Shanghai weaponized that pressure by shorting COMEX paper while holding physical. They crashed the Western price to $85 while Shanghai held at $122, creating a 43% arbitrage they're exploiting for massive profits. Number 2, next week is critical. Government shutdown odds at 85%, potential COMEX margin hikes, delivery demand building. Any of these catalysts could drive silver lower to $75 or $70 before the bottom forms. Don't buy yet. Wait for confirmation that the selling pressure is exhausted. Watch the Shanghai premium. If it holds, the crash is paper manipulation and the rebound will be violent. Number 3, the long-term bullish case is intact. 9.4 million ounces of delivery demand. Banks scrambling for physical. Structural supply deficits. Industrial demand at records. 9 straight months of gains before this crash. The fundamentals didn't break. The paper market got manipulated. And when the dust settles, the physical reality will reassert and silver will rally hard. The unresolved tension is this. Chinese speculators orchestrated a short attack to profit from the crash. But are they done? Or is next week going to bring another wave of selling that takes us to $70? And when does the physical market break from the paper manipulation and force a repricing that takes silver to $150, $200 or higher? The Shanghai margin hike triggered this crash. The government shutdown could extend it, but the 43% premium says the physical market is screaming scarcity. At some point, paper and physical will reconcile, and when they do, the snapback will be historic. Do your own research. Understand the game being played. Chinese speculators are smarter than Western retail traders. They positioned for this crash, they're profiting from it, and they'll likely push it further before covering and reversing. Don't buy yet. Wait for the catalysts to resolve. Watch for government shutdown news. Monitor COMEX margin requirements. Track the Shanghai premium. When you see the pressure exhausting, when you see the premium holding or widening, when you see delivery demand accelerating, that's your signal. This crash was planned. Next week will shock you. But the physical market will win eventually. Just don't let them catch you buying too early and liquidate you before the turn. This is Asian guy. The crash was coordinated. The evidence is clear. Don't be the exit liquidity. Wait for your pitch. Invest with logic, not emotion. I'll see you in the next one.